As we monitor the screens on this Tuesday, April 21st, 2026, Plug Power is currently trading at $3.20, marking a significant intraday jump of 15.11% from its previous close. While the broader market might be looking at this as just another volatile swing for a high-beta energy name, there is a much deeper technical and psychological shift happening under the surface that most casual traders are completely missing. You see, the common expectation for a company like Plug Power is that it will continue to be a bottomless pit for capital, constantly diluting shareholders to keep the lights on. But the reality is that we are witnessing the first real signs of a structural pivot in how the company manages its balance sheet and its massive infrastructure projects. The current move to $3.20 isn't just about a green day in the sector. It's a direct reaction to the market finally pricing in the successful execution of Project Quantum Leap and a massive contract win in Canada. Most people expect Plug to fail because they've seen the cash burn in the past. But the reality is that the company just cleared its entire moving average stack on the daily chart. For those tracking the data, the 20, 50, 100, and 200-day simple moving averages have all been surpassed in a single definitive push. This is the kind of momentum that catches short sellers off guard. And with short interest sitting near 25% of the float, we are looking at the early stages of a massive squeeze. If you are using an online investment platform like Interactive Brokers or checking your positions on the Robinhood app, you've likely noticed the volume spike. It's currently well over its average daily volume of 74 million shares. What's truly fascinating is the contrast between the institutional narrative and the retail sentiment we're seeing on investing sites and social platforms. While institutional investors have been cautious, staying focused on the negative net margins, the retail crowd has been buying the dip aggressively on SoFi Invest and Fidelity. The expectation was that the new CEO, Jose Luis Crespo, would spend his first month simply managing the decline. Instead, the reality is an aggressive offensive strategy, including a recent Reddit AMA that signaled a shift toward transparency and a disciplined execution model that the hydrogen sector hasn't seen before. This isn't just about fuel cells anymore. It's about the massive scale of electrolyzer systems, like the 275 megawatt project in Quebec, which links hydrogen production directly to the global ammonia market. Looking at the immediate trading activity, the volume we are seeing today is institutional grade. You don't get a 15% move on 5 times the normal volume without some big hands moving into the position. Many of these buyers are likely looking at the upcoming Q1 earnings report in mid-May as a potential de-risking event. If the company can show that the positive gross margins they hit in Q4 of last year weren't a fluke, the valuation model for this stock changes completely. It moves from a speculative maybe to a fundamental growth story. For anyone doing self-investing or using a robo-advisor like Schwab Intelligent Portfolios, this kind of volatility is a double-edged sword, but the technical setup here suggests that the $3.20 level is becoming a new floor rather than a ceiling. We need to talk about the hydrogen versus batteries debate because it's where the expectation-reality gap is widest. The general belief is that electric vehicles and lithium-ion batteries have already won the race. The reality is that for heavy-duty industrial applications, think massive data centers, long-haul trucking, and green ammonia production, batteries simply cannot scale. Plug Power is positioning itself as the primary utility for this hard-to-abate sector. While Tesla stock often captures the headlines for passenger EVs, Plug is building the backbone for the heavy stuff. This is why you see so much activity on the Robinhood trading platform and why people are increasingly looking for investment help to understand if this is a long-term hold or a short-term trade. The institutional activity is also telling a different story than the headlines. While some analysts have price targets as low as 75 cents, others like H.G. Wainwright are holding steady at $7. That is a massive spread. When you have that much disagreement among the experts, it usually means the market is mispricing the asset. On one hand, you have the risk of further dilution. The company did just move to increase its authorized share count, but on the other hand, you have a revenue stream that is projected to grow at an 18% compound annual growth rate through 2028. If you are managing your own individual brokerage account or using Fidelity Wealth Management, you have to weigh that dilution risk against the massive upside of a company that could potentially own the hydrogen infrastructure of North America. Let's look at the numbers for a second. The market cap is sitting around $4.5 billion. For a company expected to hit over $1 billion in revenue soon and turn positive on an adjusted EBITDA basis by the end of this year, that valuation is actually quite lean compared to other high-growth tech or energy names. If you compare this to the multiple seen in Nvidia stock or even Apple stock, Plug Power is trading like a distressed asset while growing like a high-tech powerhouse. The reality is starting to catch up to the expectation, and that's why the stock is punching through resistance levels that have held it down for over a year. Comment below how many shares of Plug Power you currently hold, or if you're waiting for a specific price target to exit. I'm curious to see if the community here is more focused on the short-term squeeze or the long-term energy transition. Beyond the immediate price action, we have to look at the macroeconomic environment.
Higher interest rates were supposed to kill companies like Plug because they rely on cheap capital to build out green hydrogen plants. The reality is that the demand for energy independence and the shift toward AI data centers has created a floor for energy demand that didn't exist 3 years ago. These data centers need 24/7 reliable power, and hydrogen fuel cells are one of the few ways to provide that without relying on a carbon-heavy grid. This is why you're seeing Plug Power mentioned more frequently on online investing sites alongside big tech names. The connection between AI and clean energy is the hidden catalyst that most people aren't talking about yet. If you're using the Fidelity mobile app or the Robinhood app, take a look at the options chain for May. There is a significant amount of call buying at the $4 and $5 strikes. This tells us that the market is anticipating a follow-through on this current move. The expectation was that Plug would stay in the $2 range forever, but the reality is that the technical cup and handle pattern forming on the weekly chart suggests a much larger breakout is possible. For those involved in self-investing, this kind of setup requires a lot of discipline. It's easy to get caught up in the hype, but you have to look at the cash on hand and the burn rate. The company is targeting over $275 million in asset monetizations in the first half of this year. If they close those deals, the liquidity crisis narrative that the bears love to push will evaporate. Now, for those who are new to this company, Plug Power has been around since the late 90s. They started by providing fuel cells for forklifts, specifically for big customers like Amazon and Walmart. That's their bread and butter. They proved the tech worked in warehouses where you can't have exhaust fumes and you can't afford to wait 8 hours for a battery to charge. But the business model has shifted. They are now an end-to-end hydrogen company. They make the electrolyzers that create the hydrogen, they build the liquefaction plants to store it, and they provide the fuel cells to use it. It is a massive vertical integration play. The risk, of course, is that trying to do everything at once is incredibly expensive. Past performance hasn't been kind to long-term holders. The stock has seen massive peaks followed by painful valleys, but the expectation that this cycle will repeat indefinitely ignores the fact that the infrastructure is finally being built. In the past, Plug was selling a dream. Today, they are selling 275 megawatt electrolyzer systems to international projects. They are shipping real hardware at a scale that didn't exist 5 years ago. When you look at your Fidelity IRAs or your Robinhood investments, you have to ask yourself if you're betting on the company of 2021 or the company of 2026. As we look toward the future, there are a few catalysts that could either send the stock back to the lows or propel it toward that $7 analyst target. First is the Department of Energy loan guarantee. If that finalizes, it's a massive stamp of approval from the government and provides the low-cost capital Plug needs to finish its hydrogen plants. Second is the Q1 earnings report. We need to see that the cost-cutting measures from Project Quantum Leap are actually hitting the bottom line. If they can show a path to being cash flow positive without needing to tap the equity markets again, the stock will re-rate almost instantly. The reality of the situation is that Plug Power is a high-stakes bet on the future of energy. The expectation is that it will always be a meme stock or a speculative play for retail traders on the Robinhood trading platform. The reality is that it is becoming a critical piece of industrial infrastructure. For those using Interactive Brokers fees as a way to trade the volatility or those holding long-term in a Fidelity brokerage account, the key is to watch the margin expansion. If margins continue to trend upward as they did in the last quarter, the bears who are shorting 25% of the stock are going to be in a very difficult position. In summary, the current price of $3.20 reflects a market that is starting to wake up to a new reality for Plug Power. We've seen the expectations of failure and dilution get challenged by actual contract wins and improving technicals. The intraday movement today is a clear signal that the narrative is shifting. We've moved from a period of survive to a period of execute. While the risks of dilution and execution remain paramount, the reward for those who recognize the bottoming process earlier this year is already starting to pay off. Whether you are using SoFi in active investing, managing a portfolio on Fidelity, or trading on the Interactive Brokers platform, this is a stock that demands your attention because the gap between what people think and what is actually happening is wider than ever. Keep an eye on that $3.23 high from today. If we break that with conviction, the path to $4 is wide open. The reality has officially begun to exceed the market's low expectations, and as we've seen today, that is a very powerful thing for a stock price. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.